Well, hello and welcome to the May 2023 edition of the ASIS Economist Board. I'm John Nelson with M&A, and I'm joined by Keith Prater of Armada. How you doing today, Keith?
Fantastic. Looking forward to it.
Great. In this video and the related subsector videos, we're going to dig into what's driving each of our forecasting models and related to what we're seeing in the real world. And Keith and I were talking off camera. There's some interesting things going on with some new data that just came in. And we're going to try to explain what we think is where the world is going and why. Each of our industrial models takes a look at 18 to 20 economic indices with our data going back over 20 years. So we think we got a pretty good handle on it. And Keith, are you ready to get into it, huh?
Let's do it. Let's do this.
All righty. I'm going to jump right into the models as long as I can find our share on our screen here. And oh shoot, well, of course, Zoom likes to play with me and move all my screens around, so forgive me. Here we go. Okay, so as we've discussed before, industrial production for manufacturing has been looking a little bit of like a downward slope overall. I do want to point out a couple things. For the next few months, even though you see kind of like this little bit of a dip, you got to remember the scale of the model. If you look on the left-hand side and the right-hand side, you see our scale. We're going from 98 to 100 is this whole, these whole double lines. And here, I can show you that a little bit better with the laser pointer from 98 to 100. So that means that this dip here is not even getting down to 99 from 100. So essentially for the next few months, all the way out to about October, even into probably November, we're looking at something that's fairly flat. So about 6 months, a little bit, or actually very similar to what we were showing before. I mean, it waves up and down, but still all the way up there, fairly flat for the next 6 months, maybe 7 months, and then starts a gradual decline downward out to, about October of the following year. So that's when we're seeing that it might drop off.
Yeah, absolutely. And John, what we were talking about right before we came on, I'm looking over here to get my data correct. We were looking at some of the new manufacturing PMIs, the purchasing manufacturers indexes that come out every month. And the one that we kind of monitor right now is the S&P Global one. It tends to handle government data a little bit differently. And so it's less prone to skews, I think, maybe than a few of the others. But that aside, one of the things that we saw in that index is it inched up a little bit this month. And so it went from about 49.2 to 50.2. And just like our model here is showing, and those models, those individual data points don't factor into the models that we use here. We're using publicly available federal economic data, for all of these models that we're building. But it's interesting how it does parallel a little bit of what we are seeing in some of the monthly surveys. And even though there's a slight uptick in activity in manufacturing, the environment continues to remain fairly, modestly weak, I would almost say. We saw some clearing of back orders, which has been one of those things that has pulled manufacturing down a little bit over the last couple months, but the supply chain is back intact. We saw just a little hint of improvement in new order demand, which is slight, but it's there, it's noticeable. And so that's kind of helping keep this thing elevated and keep the overall manufacturing sector buoyed a little bit.
Mm-hmm.
But to your point, it really is, a model really is kind of calling for a couple of quarters here of kind of the environment that we know, the environment that we've expected. So companies that are trying to figure out where to put their inventory levels or trying to figure out how far in advance to start getting ready for, maybe a sharp recovery in activity. At least right now, the model's not showing that really sharp recovery. And in fact, it obviously right now, for the moment, is getting a little bit weaker when we get out into 2024. But again, I think, as you said right up front, John, which is probably the most important fact here, even when you look at that scale from 100 to even 94 at its lowest, maybe by late next year, still not a dramatic swing on a historic basis, and that's probably what we'll see in the next few.
Yeah. Here's your historic basis. It looks worse than it is. Again, I always like to remind you of scale, but back to the point about being flat for the next few months, here you kind of see how it really does look flat. for the next few months. You got a little bit of, oscillation, which you would expect. But here's that drop off that occurs beginning the end of, third quarter. We're actually beginning of end of fourth quarter of this year and dropping off. But still, that scale that you'd mentioned, Keith, we're talking about 5% drop in the index over the following year. And, that's so far out, there's a lot that could change in that time.
Yeah, and you and I have talked about, we probably use the term tail end of the curve too much, but we've talked about that volatility on the tail end of the curve, and it does happen. But right now, at least what is feeding into the models and what the models are picking up is a little bit of weakness on the far end of that. And it's interesting because I do listen to a lot of interviews, and I've heard a lot of interviews with a lot of Wall Street analysts and a lot of CEOs, and some of the recession forecasts have been pushed even out a little bit further. And I'm now hearing a larger group of individuals they're fairly solid now calling for maybe an early 2024 recession. And whether recession hits or not, whether it officially hits by definition, or whether it's mild or shallow as kind of what we're showing here, the model is picking up some weakness as we go into 2024. And so what it's reading is something that obviously is going to continue to create sort of this downward pressure on overall manufacturing. It's picking up. And again, as we pointed out last month, and I'll just reiterate one more time on this slide and we'll move on, but look at the depth of the fall, as you said, only 5%, whereas in previous recessions, if you look at the one from the Great Recession, we went from 105 points to 85 points. And then obviously that very short drop that we saw during the lockdowns in 2020 were pretty significant. So even on the tail end of this, the model is still, even though it's picking up weakness, it's still what we would consider to be a fairly shallow downturn on a historic basis.
Sure. Year over year, you're seeing this really depicts, now if you call that our forecast is now here, the dashed line that you're seeing cutting right through the middle. And based on when this goes out, see, this goes all the way out to the end of this year. I don't go into 2024 with it. You can see just how flat it's going to be. I think it really demonstrates that fairly well. And then how consistent it is. It actually kind of looks fairly similar to 2019.
Right. Yep. Absolutely. And a lot of this will depend also on what we see in global markets. And as the global markets start to tick up a little bit, there is a little bit of residual demand that kind of flows back on the U.S. And so we have China, which we're all watching. China could reemerge a little bit stronger than expected. Although we just got some of their PMIs, and they're still really struggling trying to come out of the zero COVID policy and ending that policy, and then allowing their economy to try and expand without any restrictions. And absenteeism is still up, and the Chinese consumer is still a little bit slow to kind of get going. So not rebounding quite as robust and fast as we had expected. So that may be part of what's also keeping it flat for most of this year.
Okay, so let's take a look at the rest of the story, if you will, and go upstream. Let's go all the way up to where we can get to some of our raw materials and primary metals. And this one's interesting in that you see this little bit of a rise, but again, based on the scale, it's not that significant. And if you look all the way out to about that same period that we were talking about where it tails off, it's relatively flat. We're starting here at around 94. We're going to end right here around 94, right around that October, November timeframe that we were talking about with IP-Man before it starts tailing off. And then you can start seeing that tail off. And this tail off for primary metals is a little bit steeper in terms of magnitude, about a good solid 10 to 15 point drop now.
Yeah, John, you and I were having a discussion last week about this particular model. And, early on when we first started this is one of our worst models. It was volatile. We didn't like the accuracy on it, but we continued to work on it. Now it's actually become one of our better ones. It's actually, when you look at the accuracy levels, we're now up in the high 90s most of the time on this particular model. And even 6 months out, the last accurate reading we had was performing at 92, 93%. So accuracy on it has gone way up. So this is interesting because there are two factors here. So one is the demand side, and we know that demand actually looks like it's going to be increasing over the next, easily over the next year, maybe even further out. But the model's not picking up on that so much because we think there's a supply chain, there's a supply problem that's continuing to keep the industry kind of going through fits and spurts. So as an example, the airline industry, we know that Boeing is one particular brand still struggling to try and get all the raw materials that it needs to keep its assembly lines moving at a pace that equals its order demand. So order demand is very, very strong. They just can't fulfill enough orders fast enough to be able to meet that demand. We also see the same thing in the automotive space. I also had an opportunity to speak to a lot of construction firms over the last 2 weeks, and they're telling me that some of their metal demand, some of the like I-beams and some of the metals that they're have on order are now seeing supply chains extending the order delays on those. So they were delayed, 9 months maybe to get an order fulfilled. And they're now getting notices from those suppliers saying that those extensions are now going out 12, 14, 16 months before they can actually get products delivered. One last thing I'll throw in is they're also seeing infrastructure spending and the flow of funds out of the infrastructure bill now finally hitting the street. There you go, pun intended, right? But you're starting to see demand for everything from rebar to construction materials that go into, road, street, highway construction, along with some of those other parts of the infrastructure bill that were kind of tied to, rural broadband and improving and solidifying the power grid. Just all of those investments now really starting to pick up. Most of those categories of construction are up double digits, anywhere from 15 to 25% year over year. And we're starting to see that early spending surge as we kind of move through 2023. So I have a feeling this model will change on us a little bit. And even with the cone of variability here, you see in the dotted lines, it's showing a little better potential upside even as we get kind of late into 2023 and into 2024. Sure. So.
And it's important to look at with this particular model and with all the models, it is really important. You mentioned that cone of variability, as we call it, but that's really how much error could there be in the model? The model basically predicts, say, here's the line, but it says, it hedges its bets, if you will. It says, here's where we think it's going to be, but it could be anywhere from here to here. And when you get all the way out here, there's quite a bit of a spread. It's about 12 to 15 points either side. It's saying, now, do I believe it's going to go all the way down to 55? No, and even the model doesn't think it's going to go that far. But that's a couple standard deviations out there. But it is important to kind of keep that in mind when you look at these and you look at the trends, about how wide some of these spreads are.
That's right.
Just going to jump over to the long range on this one. This kind of shows that drop. It looks awful when you look at it on this drop. When you look at it on this chart, there's no way better to put it, and you can put it in comparison to what we saw with COVID, and it's pretty doggone close to the kind of drop that we saw in COVID.
Yeah, the one thing that could be interesting here too is that if you look at that long-term trend, look at the dotted line, which is basically the 20-year trend on that, John, and it's showing just this slow degrade. And a lot of this is, I think, due to offshoring and the offshoring that we've done over the last 20 years. But I think from what we're reading or what we're hearing, we're hearing of a lot more nearshoring and reshoring of sourcing of specifically, like rare earth materials, and trying to get at least portions of the supply chain that we're counting on and we're relying on, those that are critical to the production of like EVs and other sustainable technologies, that the sourcing of those products happens a little bit closer to consumption here in the US. And so I do think that whole 20-year trend, that part of the model, I think, will start to cock and start to change, and the model will react to it. It's already built in, so that we'll pick up on that reshoring as it starts to take place, and you'll start to see that build. But as of right now, we're not seeing enough of a percent change in that activity to convince the model that things are looking up. Right.
So let's take a look now. I'm going to jump over the year over year because I think it tells the same story, but let's jump let's move ourselves a little closer in on the supply chain. We're going from the far end of the value chain. We're, the very beginning upstream. We're at primary metals. Now we're in the fabricated metals that get changed. And essentially the story is fairly flat. A little bit more flat than what we were showing there before. We were showing a little bit of a taper off, but now fairly flat. Although one caution looking at this chart, once again, take a look at the width of the cone. It's not as wide as primary metals,
Right.
as you can see.
Right.
It's only about a 6-point spread here, as opposed, from the bottom or from the center line to the top, as opposed to where it was, a 15-point or so spread. So a little bit more confidence in the precision of the model, if you will. So I think it's going to look fairly a little bit closer to flat.
Yeah, absolutely. And this industry, again, is one of those that feeds into all the other durable sectors for manufacturing. And so when if you're a subscriber, if if you're on a free trial, go check out the other models, automotive, aerospace, machinery, and some of those others. And I think you're going to see why this particular model is starting to balance itself out. This sector, fabricated metals, is going to see a lot of spot demand, I think, from various sectors that are still growing, still showing their supply chains trying to get back into cycle. And as they start to see that flow of key component parts improve, then their assembly line activity speeds up and the demand for fabricated metals improves. And so the model's kind of picking up on that, and it's kind of creating this balanced environment moving forward. And actually, frankly, from a business perspective, if I'm trying to manage a business and manage expectations, I'd rather see a curve like this than maybe a hyper growth or a hyper contraction curve. This is actually the most manageable curve of probably everything we've got right now.
Sure. And if you take a look at the long term, it kind of reinforces that point. We're sitting just barely above trend. For all intents and purposes, you can see that for the last several months we've been following trend, and we're going to do so. If you just bump the line up just a couple points, you'd be right on it. But basically, you're following the trend line.
Yeah, and even if we were to cut this and do like a 10-year trend line, it would just be barely below, because that trend line would be right at about 99 points or so. Yeah. Yeah, not much more to add here other than at least this is a stable outlook, and it would make me optimistic about what's going to happen in the fabricated metal sector overall, if I were just to give a general statement. So I think this is improvement.
So let me throw you a curveball that we didn't discuss or anything. So this is trying to stump the chump, so to speak. We talked about onshoring or nearshoring primary metals and how that could actually help that outlook. In this trend line, we're showing this trend line going down over the period of time. How will that onshoring, if it occurs with primary metals, potentially affect the long-term trend line here?
Yeah, it'll do the same thing. And I don't know that it actually returns it back to where we were prior to the Great Recession, because what happened to a lot of companies during the Great Recession is we got hit with that global financial crisis, and companies just literally had to completely rethink the way they do business. And that's when we saw a lot of offshoring take place coming out of the Great Recession, rather than hiring back, a lot, and creating headcount, hiring people back the way they were prior to the Great Recession, and creating a cost structure. They decided to do things a little bit differently. And since everything was going through a complete reset anyway, a lot of industries that we've mapped, that you see throughout all the models that we've done, have shown this offshoring kind of taking place. So I do think the potential there is for it to return back to somewhat, closer to 110, 115. I think that's feasible on this particular index. But it will take place. It just is going to take time. And so we're seeing a lot of manufacturing construction activity in the United States, about $140 billion being invested in reshoring right now. And it's an annual rate. And so as those construction projects get finished sometime in mid to late 2024, that's when you would start to see the fabricated metal demand change, and we start to see the increase in demand for more near consumption types of manufacturing, and especially fabricated metal product manufacturing. The whole notion being, if you look at like the Japanese theory of Kaizen, right? And Kaizen is, you manufacture the products close to consumption. And that's kind of how the supply chain is sourcing is shifting again. So we're not removing 100% of the things that we source from China. But if you're a company that does multinational business, you may think about sourcing the products in China that you need for consumption in China if you're selling to a Chinese domestic consumer. Whereas in the United States or the USMCA markets, North America, you may think about doing the same thing, where that percentage of sourcing that you need to feed these markets, maybe you're sourcing a larger percentage of it, right here near consumption. So, so that will drive this fabricated metal product demand up. And so it's a great question.
Gotcha. All right. Well, that pretty much concludes our look at the industrial production from manufacturing at that 30,000 foot level. And we took a look a little bit upstream in the supply chain. We hope you enjoyed this and will join us again next month.
All right. Take care, everybody. Thanks.